Imagine a narrow strip of water just a few dozen miles across, and one of the most contested waterways in the world, even in peaceful times. Well, that's the Straits of Hormuz, and they are anything but peaceful just now. As I mentioned in a previous video, I've been through those straits twice in my lifetime at night in a darkened ship for security reasons, so I didn't get to see very much. But in this video, I wanted to pass along a little more information on the straits and the oil that does, and right now does not, pass through there. Because almost 20% of the world's oil has to squeeze through the Straits of Hormuz every single day. And shutting down that waterway has a very real effect on global energy prices. If you've filled up the car lately, you may have noticed. In the last few weeks, West Texas Intermediate crude oil traded at $43 a barrel. Then it reached a high of $119 per barrel intraday before closing at about $76 a barrel as the conflict in the Middle East continued. That, my friends, is heavy volatility. The United States, which is now the world's largest oil producer, doesn't actually depend much on this particular route anymore. And yet, what happens in the Straits of Hormuz still shows up at American gas pumps and even in investment portfolios. Let's unpack why. Straits of Hormuz sits between the countries of Oman and Iran. And the straits are the only sea passage for most of the Persian Gulf's petroleum exports to reach the open ocean. In early 2025, the world was producing about 77 million barrels of crude per day. And out of that, about 14 million barrels per day moved through this one narrow waterway. Now, of those 14 million barrels, roughly 90% of the crude and condensate moving through the Straits of Hormuz headed to Asia. About 38% went to China, a little less than 15% went to India, about 12% to South Korea, and about 11% to Japan. Those four countries alone account for more than 3/4 of the oil passing through the Straits of Hormuz on any given day. By contrast, the United States represented only about 2.5% of the Strait's total volume. So it seems, logically, in physical terms, that this is far more of an Asian energy lifeline than it is an American one. And given those numbers, you might think, well, if the US doesn't import much oil through Hormuz, why are gas prices rising during the conflict there? Well, here's where it gets a little bit counterintuitive. You see, oil is priced in a global market. There isn't a single price for Asian oil and another for American oil. It's all just oil. It's all in one big proverbial pot. So if a crisis in the Straits of Hormuz suddenly makes it harder for China, India, South Korea, and Japan to get the oil they need, global supply tightens. And when global supply tightens, all else being equal, which is the economist's favorite disclaimer, prices rise everywhere, including in the United States, even if the physical barrels that Americans are using are coming from Texas or North Dakota instead of the Persian Gulf. That's the paradox of US energy independence. The US is far less dependent on imported oil than it once was. It's now the largest producer in the world, but it still pays the global price for a globally traded commodity. So when we talk about the risk in the Straits of Hormuz, we're really talking about Asian energy security on the front line and shared price risk for everybody else. So if you're following the news, that's where the US Strategic Petroleum Reserve, the SPR, comes into the story. Think of the Strategic Petroleum Reserve as the country's emergency oil savings account. Except instead of a digital balance on a screen, it's real physical barrels stored deep underground in salt caverns. The SPR is made up of about 60 man-made caverns across 4 sites along the Gulf Coast, 2 in Texas and 2 in Louisiana. And these locations were chosen for one simple reason. They're close to where the oil can actually be used. From these caverns, oil can reach nearly half of all U.S. oil refineries through interstate pipelines or via barges. Now, the caverns themselves are huge. You can picture a roughly cylindrical space about 2,550 feet tall. That's almost half a mile and around 200 feet in diameter. In total, the SPR is authorized to hold up to 714 million barrels of oil, but today it's nowhere near full. As of March 6th, the SPR held 415.4 million barrels. Now that's up about 19% from the recent low of 346 million barrels that we reached back in July of 2023. So on paper, the SPR is a substantial buffer. It's strategically located and it's relatively cheap compared to current oil prices because the average price the government paid for the oil in storage is about $29.70 per barrel, well below recent market prices. But this is not a magic solution. It's got some built-in limits and delays, and those matter in a fast-moving crisis. When there's a major disruption, the SPR doesn't just switch on like a light. First, the president has to authorize a release of the reserves. Then the Department of Energy has to organize sales or exchanges and schedule those deliveries of the physical barrels of oil. In practice, this typically takes about 13 days from that decision for SPR oil to actually start reaching the market. 13 days might not sound like much. It may be only 1 or 2 fill-ups, depending on how much you drive, unless you're living through a major price spike, or you're a refiner trying to replace your lost supplies. But there's also a physical ceiling on how much can be released at once. The SPR's maximum drawdown capacity is about 4.4 million barrels per day. That's powerful. But we have to compare it to the 14 million barrels that are coming through the Straits of Hormuz, or were pre-crisis. So it's not enough to offset the closing of the straits on a day-in, day-out basis. Even at full throttle, the SPR could only cover a portion of the flows that are disrupted when the Straits of Hormuz are fully blocked, and only for as long as the stockpile lasts, which is projected to be about 125 days at full flow. So the SPR is best understood in this crisis as a shock absorber. It can help smooth out short-term disruptions, and it can buy time for markets to adapt and for other producers to ramp up, or for diplomacy to do its work. But it's not an instant fix, and it's not a substitute for the ongoing global flow of oil, especially through critical choke points like the Straits of Hormuz. Put it all together and a picture emerges. The Straits carry around 14 million barrels of oil a day, nearly a fifth of the world's supply. And about 89 to 90% of that is bound for Asia, especially China, India, South Korea, and Japan. The United States is physically less dependent on those flows than it used to be, thanks to rising domestic production. Yet the U.S., like everyone else, still lives in a globalized world, a world where one narrow waterway, thousands of miles away, can and does move prices at home. The SPR, the Strategic Petroleum Reserve, gives the U.S. a valuable buffer. Hundreds of millions of barrels stored in half-mile deep caverns along the Gulf Coast. It's enough to cover about 125 days of net imports, but only after a roughly 13-day delay and only up to 4.4 million barrels per day. If this kind of clear, data-driven breakdown is useful to you, please make sure you don't miss the next one. Subscribe for more explainers on markets, geopolitics, and energy security, and share this video with someone who still thinks energy independence means we're insulated from global shocks.